Dreaming of your own home? It's exciting, imagining your furniture, your family, your future. Maybe you're tired of rent or need more space. But then comes that big word, mortgage. Mortgages can sound intimidating, but they're just a tool. A big loan from a bank to help you buy a house. Most of us don't have crores lying around, so a mortgage bridges the gap between your savings and the home's price. You borrow from the bank, pay it back over time with interest, and the house itself is the collateral. If you can't pay, the bank can take the house back. It's standard, not scary. Just the way home loans work. Mortgages make homeownership possible for millions in India every year. We'll break down the process, types of mortgages, how to get one, and how to manage it wisely. Think of me as your guide. By the end, you'll feel confident and ready to make smart choices. Your dream home is out there. Understanding mortgages is the first step to unlocking the door. Let's get started. We'll keep it simple, practical, and focused on what you need to know. No jargon, just clear steps. Ready to begin your journey? Let's dive in. Let's break down what makes up your mortgage. First, the principal, the amount you borrow after your down payment. The down payment is your upfront investment, usually 10 to 20% of the home's price. A bigger down payment means a smaller loan and less interest over time. Next, the interest rate, the bank's fee for lending you money. Even a small difference can cost or save you lakhs. Your credit score, CIBIL, affects your rate. Higher score, better deal. Then the loan term, how long you'll repay, usually 15, 30 years. Longer terms mean lower EMIs but more total interest. Shorter terms mean higher EMIs but big savings on interest. Your EMI, equated monthly installment, is a fixed monthly payment, combining principal and interest. Each part, principal, down payment, interest, term, shapes your total cost. Understanding these helps you compare offers and plan your budget. Next, let's see how your EMI actually works. Onward. Ever wonder where your EMI goes? It's split between interest and principal. Early on, most of your payment covers interest because your loan balance is high. Only a small part reduces your principal at first. Over time, as you pay down the loan, the interest portion shrinks and the principal portion grows. This process is called amortization. By the end of your loan, most of your EMI goes straight to principal. It's a slow shift, but it accelerates as you get closer to the finish line. Understanding this helps you see why patience pays off. Stick with it, and you'll watch your loan balance drop faster every year. That's the journey to full ownership. Not all mortgages are the same. Let's find your best fit. Fixed-rate mortgages keep your interest and EMI steady for the whole term. Great for predictable budgeting. Adjustable-rate floating loans start with a lower rate, but your EMI can rise or fall as market rates change. If you plan to move soon or expect your income to grow, a floating rate might work. Government schemes like PMA offer interest subsidies for eligible buyers. Check if you qualify. Jumbo loans are for high-value properties and come with stricter requirements. The right mortgage depends on your finances, plans, and risk comfort. Talk to your lender, compare options, and choose what fits you best. The right choice makes all the difference. Here's your roadmap to getting a mortgage. First, check your CIBIL score. Aim for 750 plus for the best rates. Fix errors and pay off debts to boost your score. Next, get pre-approved by submitting your financial documents to a lender. Pre-approval shows sellers you're serious and tells you your budget. Start house hunting within your price range. Once you find a home and your offer is accepted, apply for the loan with property details. The bank will verify your finances and the property's value. They'll do a legal check and appraisal to ensure everything's in order. After approval, you sign the agreement, pay your down payment and closing costs, and register the property. Congratulations, you're a homeowner. Stay organized and responsive to keep the process smooth. Preparation is key. Now that you own your home, manage your mortgage smartly. Always pay your EMI on time, set up auto debit to avoid late fees and protect your credit score. If possible, make extra payments toward your principal. This reduces your interest and shortens your loan. Check for prepayment rules or penalties with your bank. Remember, homeownership comes with extra costs, property taxes, and insurance. Budget for these separately. Set aside money monthly so you're not caught off guard. Build an emergency fund with 3-6 months expenses including your EMI. This safety net protects you from job loss or unexpected repairs. Stay proactive, review your finances regularly, and adjust as needed. Responsible management keeps your home and your peace of mind secure. You've got this. You've learned the essentials from what a mortgage is to how to manage it. Buying a home is a big step, but knowledge is your best tool. Remember, a mortgage isn't a burden, it's a bridge to your own home and future security. Every EMI builds your equity and brings you closer to full ownership. Do your research, save for your down payment, and compare lenders for the best deal. Surround yourself with a good team, ask questions and seek advice. Don't rush, plan carefully, and stay disciplined. Picture your new home, the memories you'll make, and the legacy you'll build. With smart planning, you can turn your dream into reality. The journey is worth it, and the reward is priceless. Stay confident, stay informed, and take the leap when you're ready. Your new home and your future awaits. Good luck.